Here's the key thing is you learn as a strategist. When you say something that you feels a little bit against consensus and people respond to you with some angry chagrin, then you know what their position is, and you know you touched something. And when the problem is when everybody agrees with you, you're usually wrong.
The Federal Reserve has started cutting rates, and the market is paying attention to see what comes next. Is there going to be a big rally? Is the struggling economy going to pull the market down, or is something else going to happen none of us see coming? Hello, and welcome to Milk Road Macro, the podcast that thinks that FOMC meetings are more fun when the most exciting thing is guessing whether or not Jerome Powell is going to start the press conference by saying good afternoon. I'm your host, John Gillen. Today is Wednesday, September 17th, and today we are joined by everyone's favorite bear, Mike McGlone. Mike is a senior commodity strategist at Bloomberg Intelligence, where he leads research on commodities, futures markets, and emerging assets like digital assets. Mike's career spans over 25 years, includes roles at the Chicago Board of Trade, head of U.S. research at ETF Securities, and he was the leader of the commodities business at S&P Indices. Mike is going to break down everything you need to know about the Fed's FOMC meeting, how to apply it to the market, how to think about it as an investor. So if that sounds good to you, make sure you like and subscribe. Share this episode with someone who's going to enjoy it. And I want to remind you all about the Milk Road Macro newsletter. Macro is confusing. We're here to fix that. The Milk Road Macro newsletter is your shortcut to understanding everything that's going on in the big picture in markets, delivered straight to your inbox twice a week. Make sure you hit the link in the show notes to subscribe there so you don't miss the alpha. Today's episode is brought to you by KGeN, the verified distribution protocol changing the growth game. And without further ado, welcome to Milk Road Macro. Mike, how are you, sir?
I'm good. Wow, that was a lot of words, a lot of stuff in one sentence. I'm a fan of small intros, but thank you. I appreciate it. And one thing I want to mention about my background is I've got all this experience and advanced degrees, and it's nothing comparable to those 5 years I spent in the Chicago trading pits. I mean, that was it's worthy of a couple master's degrees.
Yeah, well, that's why I included it in the intro. I think it's a really great place to start a career. Obviously, yours has been interesting. I wanted to start with what's on everyone's mind right now. The Federal Reserve just finished their press conference for their FOMC meeting. They've decided to cut interest rates by 25 basis points. Your initial reaction coming out of this conference, what are your thoughts on where we are with this?
Well, my initial reaction is this is unprecedented, and they have a sitting member of the President's Council, Chairman of Economic Advisors, now on the Federal Reserve Board. I mean, that's one thing I look at that, and I think, and I guess Mr. Moran said he wanted to cut 50 basis points, not 25. It's just, every time I see this kind of stuff, I think the gold market looks at it and says, and it smiles. Thank you very much, Mr. Trump. We love you. But overall, we're getting the first cut in since last year at this time. And the key thing to think about here, and everybody to think about, John, is some of the narratives are just completely false in some ways. That, oh, the stock market outperforms and the Fed cuts rates. Well, I don't know about you how you were trading in the year 2001 when the Fed first started cutting rates, and after that the stock market, S&P, dropped almost 50%, and then in September 2007 stock market made a new high a little bit after that and dropped 56%. And I just love when people use these false narratives of statistics to help them feel comfortable about being in positions that most of them know are just way overweight and way extended. And yeah, I'm a bear, but I'm very bullish gold. And that's part of the reason I'm very, very concerned about risk assets like cryptos and the stock market. And I'm sticking with my bullish gold stance. But overall, from what the Fed did today, a lot of this is political pressure. And I think it's okay to drop 25 basis points. But this can be a key risk as we go forward. So right now we're recording, I'm in London, so it's just about 8 o'clock, and this data has been out for a few hours on the 17th, and it's September. And Q4 and Q3 end soon, and then it's Q4. So I'm really worried we're at a situation where, stock market volatility is extremely low as we speak. That VIX is running 16. I think 16 is okay. The low for the year was in August, around 14 and change. That we might get a pickup in volatility in Q4. I mean, it's just so, most astute investors get it. I've been in London with some of the smart money I've spoke to for years, and it's like so matter of fact that, yeah, you're supposed to be selling U.S. assets and finding alternatives and buying gold and stuff. But for now, with what's happening with the Fed, sometimes this is a trigger for markets to move. And as we speak, we had a little dip in the stock market. Looks like it's hanging in there. But what's going to happen, I think the key thing I want to end with, John, we're in a situation the stock market absolutely has to go up. Because everything's so priced for it, everything's so expected for it. I hear all the economists say, yeah, when the Fed eases, stocks always outperform. And that I like to point out is no. When the Fed starts easing cycles, gold almost always outperforms the stock market, depending on what period you look at.
So there's a lot that was in that answer. I think that's a great overview. I want to kind of take this piece by piece and sort of break some of these things down for the audience. Jerome Powell, in his comments today, said that this was a quote, risk management cut, meaning that this is not a full pivot to dovish, total go back to 0% interest rate monetary policy. A lot of analysts have been predicting this sort of like hawkish tone from Powell, so that there would be a cut, but he's not going to like try to release the stampede of bulls. Do you think he struck the right balance there? Do you think that's the right way to interpret the comments here, or do you think that there's also an expectation from the governors and from the markets that there'll be 2 more interest rate cuts? How are you reading this in terms of that market sentiment? Is this a full pivot to bullish dovish sentiment, or are we still in like a hawkish position here and he's just adjusting policy?
The latter. And just using a lot of words to describe, we're cutting rates, and partly because there's a lot of political pressure and we're way above targets and we're worried about the labor market. I mean, to me, that's all you really need to say. And then there's everybody else adding a lot of stuff to it. The bottom line, one thing I'm looking at is I like to look at Fed fund futures in 1 year. So that September Fed fund futures right around 3%. It's actually up a little today, meaning it was priced a little below 3%. Means by September next year, we should have Fed fund future at 3%. Death taxes and Fed funds at 3% next year is what should happen. And what stops that? The key thing that I think about here is inflation staying sticky, the labor market staying strong, and there's no reason to bring Fed and stock market staying strong, and labor saying there's no reason to bring Fed funds to 3%. But the number one force to make Fed funds drop below 3% as we speak a year from now would be the stock market going down, because we're at the point now when you're at 2.3 times GDP. I mean, the stock market is $70 trillion and the economy is about $30 trillion. You get that high, it is like the stock market is the economy. So that to me is all that matters. And we talk about consumer spending and stuff. Yeah, the bottom 50% of most people in this country are struggling. The top 10% who own 80% of stocks are doing just fine because their risk assets are the most expensive on the planet. There's going to be no major shift in inflation expectations and spending and stuff until the stock market goes down and reduces the greatest wealth effect in our lifetimes. And that's just a fact. And I think the Fed gets it. They have to be careful. I think Mr. Bessent really gets it. Trump, I don't know if he gets it or not. That I'm really worried about the timing of his just poor timing. And he's got potential at the same timing as Herbert Hoover as far as how expensive the equity market is. So to me, that's all that matters. And I like how you pointed out me, I'm a notable bear in the stock market. I'm less a bear and more looking for alternatives. So, and that is why I point out was what's happening in gold is just plain scary. Gold is up 40% or 30% this year to date, 40%, I'm sorry. And that is the greatest year since 1979. Now, bond yields peaked in 1981. The stock market was collapsing. Unemployment, CPI was running 10% then. And the fact that it's rallying that much is telling me something's wrong with this AI-driven stock market. And so I'm really concerned that we should be focusing on risk-off assets like gold and treasury bonds rather than piling onto a trade like this. And I think sometimes these are the triggers, events like this. So today is just more of an event. It's so widely expected, like it's so widely priced in that we're going to be at 3% Fed funds in a year. Key thing you have to ask yourself is what changes that path in the next year. And for me, as a commodity guy focusing on crude oil collapsing and gold going up, these things only usually happen in pretty significant global recessions. And we're seeing that. Certainly Chinese 10-year note as we speak is 1.77. The US 10-year note as we speak is 4.07.
Yeah, so I think there's, again, a lot to unpack in there. I want to kind of stay with the Fed. I think you're getting into a lot of things with the market, with commodities, with what your expectations are for the equities market. And I want to touch on all those things too. A couple more things I want to touch on about the Fed before we move on, though. There was going into this meeting, something you said you were paying attention to was the dissenting votes. In other words, members of the Board of Governors who did not agree with the 25% reduction and either wanted more or wanted to hold rates. I think, as you said, Stephen Marin, the president's most recent appointment to the Board of Governors, he was only 50 basis point vote in this meeting. What are you taking from this? Do you think that this is going to be a totally different Fed next year, right? Because like the way I'm seeing this is like in May of next year, Powell's going to be gone. He's going to be replaced with someone who's loyal to Trump. Stephen Miron, who's very loyal to Trump, is going to be on the board. He's going to get to a majority. That, you said the 3% Fed funds target, that might be where it is now. That could move even further down. Like, how do you see this kind of playing out in terms of like the changing winds on the board of governors itself?
Let's not forget who appointed Chairman Powell. President Trump. And when you put a astute, smart human like Stephen Moran or Chairman Powell in the position like this, they have to focus on the future and the legacy and doing the right thing. They don't want their name to go down like mud. And so I think we have to be careful with people who think they're just going to cut 300 basis points when President Trump gains control of the Federal Reserve. I think there's a risk that they're going to have to cut a lot because the stock market's going to tell them to. To me, that's the key thing I'm focusing on. That to me is what the gold market is telling me. And so I'm not worried about that so much because there still is, and if they do make the mistake of being very political and just cutting rates a lot, let history judge them accordingly, like Aaron Burr. This is going to happen. And that's like, I think people need to remember when I hear this from crypto people a lot that, the Fed's going to cut 200 basis points as soon as Mr. Trump gets the people he wants in there. I'm like, yeah, and then what? So what does that mean for the market? In the meantime, we already have a market that's the most expensive in history by market cap to GDP. Now you can push back on that one, but when people do, I say, well, how about the rest of the world's stock markets? We're still just a few months ago the most expensive in our database ever. There's a risk that we just get a little reversion. And then I also recently put out that you look at U.S. Treasury bonds divided by the price of gold. The Treasury bond prices, that's the cheapest since 1983. Just a little reversion. Those kind of trades is what I think gold's telling me, and that's what I'm looking for the trade, and might be kicking in by the end of this year. So my main take is, John, is we have to be very careful with some of the assessments people are making about what might happen to the Federal Reserve Board. This is a tremendous institution. If Trump messes it up, it'll tilt maybe negative for a little while, and then it'll never go, it'll always go back to positive. So it might tilt negative for a little while, meaning to become somewhat politically motivated. But I've been, a Fed watcher for almost 40 years. And I mean, I remember those days of the maestro speaking and making a lot of money and being able to figure out the Fed, what they were doing. And right now they're cutting. I think it's somewhat appropriate because I do think the labor market is clearly weakening. And that's one thing I really enjoy about the labor data. The U.S. Bureau of Labor Statistics data completely matches what we're getting from initial claims from the states, completely matches what we're getting from ADP, and what we're getting from the surveys, the ISM surveys. It's not manipulated, but it's the key thing that I keep taking away from all this, John, is every time I hear this kind of pushback on some of these things that made America great, I think the gold market smiles. And so today we're speaking, gold's down a little bit, but it's up 40% on the year. Sure, there's got to be some profits to take there. And so that's my bottom line with all these things that we're talking about that I never thought we'd speak about with, pushing back on Federal Reserve independence openly like this. I think, so where's the VIG? Where's the value here? What can I do what market should perform the best? And that's why I think right now I'm really concerned that gold is very scary. It's telling me there's an issue. And if we just get to say, okay, so on the year, total return S&P 500 is 13%. It's a great year. We still got 3 months. If it ends up the year 13% or more, everything's fine. The Fed does have no hurry to cut rates. Inflation will stay sticky because it's greatest wealth effect ever. They might keep cutting, but if they keep posting it too high, it just means when it falls, it'll be that much further. Picture this, John, if we just start ticking down by the end of the year, we start hitting some of those stops, hitting some of those algos that drive cryptos. That's an optionality trade that I think gold might be figuring out that might be the next big winner. That's why I want to start out when I started out with. I think I see situations happening here very similar in 2001 when they first started cutting rates. The stock market wasn't any nearly as expensive as it is now based on many measures. It was pretty expensive versus gold then. And when they started cutting rates in 2007. And both of them made some decent money. I was trading. I don't trade anymore, and I was early on both. And yeah, I've been early, but not on gold. And so beginning of the year, my target was, I think this is going to be a down year for the stock market. I think gold's going to be one of the best performers. And I think crypto is going to lead the way lower. Been completely wrong on stock market being down, but the year's not over. So that's why I'm pointing out there might be a big trade here, and we can at least have a little pickup in volatility. So here, I'll end with this. The 200-day moving average of the VIX was running around 15% when Mr. Trump was elected. Now it's about 19%. And as we speak, the VIX is, we just mentioned, it just dropped down to 15.8. I fully expect at some point we'll have at least a trade this year. The VIX will pop up to near 1920. you get a chance to sell it. If it stays above there, oh boy, now that's a big trade. That means it's going to continue moving higher. And Bitcoin's going to have a chance to, you probably get a chance to buy it around 100,000. Question, does it stay there or not? But we still got a lot of trading left in this year, and that's why I think this is just part of the trigger to be potentially the next big trade. I still think it's going to be treasury bonds. I've been saying it for a while. I've been wrong. But I'm trying to focus on what's going to happen. So right now, so here's one thing that's notable. 10-year note yield. The low for today was 4%. The high for the year is 4.80, and it's still ticking lower.
Most Web3 projects launch a token first, and revenue, maybe later, maybe never. But KGeN flipped the script. $30.6 million in ARR before a token ever existed thanks to VeriFi. Cash flow positive, growing month after month, and powering 31 million verified users across AI, gaming, and consumer apps. In a market full of hype and empty metrics, KGeN is proving that Web3 can be built on real revenue, real users, and sustainable growth. Want your protocol to scale with results that last? Grow with KGeN today at milkroad.com/KGeN. Okay. Mike, that was a lot of answer to the question there. I'm not really sure where to start with some of these things. I think that you're raising a lot of things. You're giving a good framework for how you're thinking about the market. Yeah, look, I think gold is going to continue going higher. I think that the risk assets are too. I want to get into this with the market, and we can kind of trade some blows on this because I think we see a lot of these things differently. I think Bitcoin, for example, like you've been saying, is going to be bottoming out or collapsing and losing a zero. That's been much stronger this year than I think you've been expecting. I hope that continues as well. Before we move on from the Fed, you started with this answering this question about politicization of the Fed. Stephen Murin being on the board of governors, a new chair coming in. There's been some talk now circulating on Twitter. Like Arthur Hayes has retweeted this. Larry Lepard, author of The Big Print, has retweeted this. A lot of people are talking about this now. This idea that there's going to be a third mandate added to the Fed's existing dual mandate of low inflation, low unemployment. The third one that's being floated is, quote, moderate long-term interest rates, which a lot of people are interpreting as the Fed beginning to softly, float the idea of yield curve control. Could you tell us a little bit about the idea of yield curve control, why the Fed might do it, and do you think that this is just a rumor, or is this something they might seriously be considering as a policy thing, or is this just one of those things the Trump administration does? They float a trial balloon to see how the market reacts and then just like withdraw it and pretend it never happened. Like, what are your thoughts on this idea of yield curve control coming from the Fed?
So I'll go to that. First, I want to address, I'm a big fan of Larry. His book would have been wonderful if it came out in 2019, because we've had the biggest print in history. It was be careful with recency bias. People are focused on the last big trade, which was inflation, the biggest print in history. After you get inflation, the rules of cycles in markets are deflation. It's happening in China, happened in Japan, it happened in the US in 1930. So tilting over to what you just mentioned about yield curve control. According to my colleague, interest rate strategist Ira Jersey, it's been part of the Fed's mandate indirectly, maybe seen in the past, for moderate to low long-term bond yields. It's the stated goal of the Trump administration to reduce inflation and reduce yields. I think they're going to be right. And the best way to do that is the stock market to go down just a little, maybe just 20%. Oh my gosh, stuff that used to happen, and stay down for a while. I guarantee if that happens, and say the stock market were to jump 20%, that 10-year note yield at 4% would go to 2. Mike's call. I mean, if it goes down and stays down for a year or so, we'll go to 2, because that'll be the most deflationary force in the country we've ever seen. For 20% decline in the stock market is about $14 trillion, which is about 40% of GDP. Just the fact I said that, it's shocking. But the key thing is the Fed, basically, the old saying when I used to trade treasury bonds and then trading, the Fed doesn't control bond yields. Well, yeah, but they do. They can buy them when they want. If they get out of hand, they can buy all they want, and they've learned they can. And the QE, buying off the runs. I remember when I was making markets, I would offer some off the run markets to them once in a while to the Fed. They can do what they want if they want, and they've done it in the past. They did during World War II. We've seen QE before, so they don't really control the long end. It's really more the wild part of the whip, but they can if they want. And it's their stated goal for, first of all, for lower energy prices, which we're getting. Crude oil's down 11% this year. Think it's going to go lower. That was been my call for a while as a commodity guy. It's just what it always does. It gets cheap. Obviously, I made that call way too early when I was above 100. They would go to 40, and here we're at 63. It's still heading that way. So that's a deflationary force. But that's the state of go. I think they're going to get it. And I think we'll just see what the stock market has to say about those lower yields. But the thing to remember is I do enjoy when they say, oh, if the Fed would cut rates, not just them, but some people like Elizabeth Warren, no, that'll help reduce mortgage rates and things. And like, well, no, that's not true. The Fed cut rates starting last year under a lot of pressure and mortgage rates went up. Well, one of the big reasons it went up is because the curve is inverted somewhat then, and there's a lot of room for bond yields to go up. Now it's steeper. You got right now the long bonds at 467, 10 outs at 353. It's pretty steep already. So there's not a lot of room for, and 406 right as we speak in that 10 There's not a lot of room for that, that re-steepening that we got last time. So it's just not a given that if they cut rates that bond yields will decline, although they can make them decline. The key thing to remember is the number one thing that affects bond yields and our inflation expectations. And right now, at 2.3 times GDP, the greatest wealth effect in history, there is no reason for inflation to decline when we have this much wealth creation going on in the economy. But you take a little bit of that away, maybe just what used to be normal 20% corrections, which is 40% of GDP. Yeah, that's pretty solid deflation. Here's a key thing to remember, John. In history, every single time you get inflationary cycles like this, you always go to deflation. That's why I like to point out to crypto people who are buying these treasuries in Bitcoin. The time to do that was when Michael Saylor did it, when crypto and Bitcoin was around 10,000. Great trade, went up 10x. The time to sell is when they're yelling, and they're yelling now. And so I'll just repeat one thing I said in 2018 when Bitcoin just bumped up around 10,000. I think, yeah, without a comment, it's going to lose a zero. Guess what? I was wrong. It dropped to 3,000. Took a while. So I got 70% of that trade. It's the rule in trading. If you can get 60 or 70% in the trade, you're doing fine. So far, I've been wrong. But I just, to me, that's going to be the next big catalyst. I look at what might trigger some normalization of risk assets, and I look at, there's only 21 million cryptos now. There was one in 2009. That's called unlimited supply, massive speculation, and hubris. And if you're in the past, what I really liked about it is I like to say you can't hold and invest and trade in gold anymore without some Bitcoin in that space. I mean, if we want to go there a little bit. But the key thing is we have to point out that's the tip of the scale for what could happen. It led the way up. And if you're looking for signs for what might trigger a little bit of deflation, which I'm expecting, that's why I'm keeping my eye. And so I'll end with this. On a year-to-date basis, Bitcoin sucks. I mean, I just point out the facts of its performance. On a year-to-date basis, it trades 2 to 3 times the volatility of the S&P 500. Bitcoin's up 23%. Gold's up 39%. Risk-adjusted, Bitcoin should be up about 60% or so on the year. And it's not. So it's showing, my point is it's starting to show signs that my job is to look for these inflection points of divergent weakness, despite the massive inflows. And that's the key thing I look at. I'm just looking for signs. So as we speak now, everything's fine. Yeah, everything's fine for a while, but gold keeps telling me you got to be worried.
Okay. I love these answers. If I just let you run, you'll just keep going. I asked about yield curve control, and we ended up on Bitcoin price predictions.
Well, we did. We started. I pointed out about yield curve. The Fed can control the curve all they want.
Well, so I think that the goal of the administration, right, is to try to run the economy hot. They want. I think look, you're talking about a 20% correction, which used to be a normal thing. I think Powell's dream is that the economy starts to heat back up again. We get some hiring coming back in, but that the stock market just kind of stays flat. I would think he would like to see this be a situation, all of them would like to see this be a situation where we're able to get some demand back into the treasury market, some life back into the economy, some hiring pickup, some real growth in that, not just in nominal GDP terms, but not have to have one of these big 20% corrections and pullbacks. Now, are they going to be able to do that or not? I don't know, but that to me seems to be the objective that Stephen Miran and the Trump administration and Scott Bessent are all shooting for. I don't know if they'll hit that target or not, but that's what they're gunning for. As far as Bitcoin goes, I tried to promise myself I wasn't going to get into an arm wrestling match with you about this, but there's a couple of things I think you could benefit from, which is that number one, the 21 million other digital assets that have been launched are not really competing for the same real estate in the market that Bitcoin is.
Did you ever look at the volatilities? The correlations? The correlations are very high.
So, but this is what I'm saying is that they're correlated in the sense that they drive retail interest. People speculate on them. I understand there's a lot of beta to Bitcoin itself, but they're not really trying to go after that same niche in the market. And I think that Bitcoin is becoming that.
So you can believe that you can believe that all you want. I appreciate, but now let me appreciate that. What does Tommy Lee think about that? I think he's tilted towards Ethereum.
hold on, wait a minute, hold on. Let me finish my point here. What I think is the case with a lot of digital assets, and they're all different, right? Like Ethereum has many different applications and use cases than Bitcoin does. But I think a mistake that a lot of people make with these digital assets is that they take one of the, like, you're saying like Bitcoin is a risk asset, and it is
So
primarily
I'm not saying it is a fact. Just look at the volatility and look at the correlations.
But the volatility this year, as you pointed out, the performance has been much more stable, much more stagnant, much more right. So that historic volatility has normalized. It's become a more mature asset. It's going trading sideways. So that's a change that we've seen in the market behavior recently because it's an emerging asset. And then the other thing I think is that a big mistake see a lot of people make in digital assets and outside of it is that they look at these things and they say it's only this, it's only that. In 1 Corinthians, Paul says, I become all things to all men. There's many different investment theses for Bitcoin as there are investors in Bitcoin. So some people are using it as a bank account. Some people are using it as a store of value, like a gold substitute. Some people are using it for alpha, for outperformance, for a risk asset. And I think that as this asset class matures, the market share of investors who are investing in it because of those different theses is going to change and evolve. And at different times in different places, it's going to behave different ways. But I think it's a mistake to say that it's only one thing. And that's the only thing I would really,
But I'm not saying words in my mouth. Let's be careful here. So let's just point out the facts. So you're talking to an old fart who knows nothing about markets. That's fine. You can treat me like that all you want, but let's be careful. Let's just be careful about. I have no vested interest in markets. I have vested interest in being right. And that's a key thing you have to be careful about. Some of the clients and people you speak to, it's like talking to World Gold Council. They put that on the best day in the world, but it's always bullish gold. And the key thing to remember about Bitcoin is some of us were very bullish at 3, 4, and 5,000 in 2017 and then 20, and they're very bullish. I mean, I called for 10x. I got it. The difference now is there is unlimited supply speculation. All my indications show the highest volatility, the highest correlations ever from the crypto market to the stock market. And you're also living in a space that most of us have never lived in. We're running 2 times GDP in the stock market. The correlations led by cryptos are the highest ever. And that's why I like to simplify it down to there was 1 in 2009, and now there's 21 million. And they're called cryptocurrencies, or they're called digital assets. What do you want? The key thing to remember is I've always been quite bullish about the technology, and the technology is stablecoins is nothing but a bull market. I agree with Scott Bessner. We're running almost 300 billion now in assets there. I think it's going to 10x and who knows what period. I remember pointing that out in 2018. The significance, it nullifies, because Satoshi Nakamoto's first statement in the white paper, this peer-to-peer cash for Bitcoin. When you can transact, transmit, and translate a dollar for pennies, for nothing on your phone, why would you try and take the extraordinary risk of Bitcoin? Now, the key thing to remember is we haven't had the test. We need a test. We have only had 2 down years in the stock market, S&P 500, since Bitcoin was launched in 2009. It really started trading, and each time it went down a lot. People tell me that's changed. I'm like, okay, good luck, prove it. I just like to point out it's a risk-on asset. The whole crypto space is a risk-on asset, and they'll do fine in a risk-on environment. Gold's telling us there's a bit of a difference. So those are facts of correlations existing now. Now, if you want to predict the future, go ahead. My point is, if you're going to predict a shift in those correlations and to be different this time, well, I say do that with your own money.
Right. Well, that's a nice way to put that. Look, Mike, I want to say you're my guest. I'm the host. I didn't mean to be confrontational.
Not
One
at
of my
all.
favorite things about you. No, yeah, exactly. And this is what I love about you and why I wanted to have you on the show. Of all the people I've seen who are bears, you are the person who I think is the most willing to go and share point of views that disagree, but then do it with a good spirit of trying to learn from one another. That's one of my favorite things about your experience on Macro Mondays on the Wolf of Wall Street channel, which if anybody doesn't watch that, I recommend you check it out. It's great. So I think it's we could go back and forth about this a lot. I want to kind of bring in some of your experience in commodities because I think our audience is, primarily retail. They don't know a ton about the commodities markets, and without getting into the whole landscape of commodities trading, I'd like to go and just talk a little bit about gold because you've been very much banging the table on this all year. The performance has been incredible. It's now over 3,700. It keeps putting in new highs. Tell our audience what we need to know about the gold markets, not just in terms of what you expect for performance, but what the message this is sending to investors and what they need to pay attention to as it pertains to the gold market.
Well, John, I'd rather be confrontational. Let's talk about the markets I've gotten wrong, like cryptos lately. But no, that's more fun. So that's the key thing. Is it's my job to be able to step ahead, look forward, and try to identify patterns, and inflection points. And the key fact I've been worried about gold is let's point out, gold. The S&P 500 total return is flatline versus gold's about 8 years, not even further than that, but I'll just the most recent 8 years. The Bloomberg Galaxy Crypto Index has flatlined versus the price of gold for about the last 8 years. That's a bad sign. This ancient store value, as crypto people call boomer rocks, when risk assets start underperforming the most ancient store value on the planet, that's a signal. And then I look at, is there a reason for it? Yeah, I mean, we're so elevated, and there's the hubris in this space is shocking. Just like when I was a big fan. I remember, we know that in 2022, Bloomberg says, Mike, we're going to have the first, open conference, after COVID. We want to do it in Miami, and we want you to do interview whoever you want. So I chose Michael Saylor. Very bullish cryptos. Bitcoin is around 10,000. I'm like, I thought it was going to go to 100,000. I could see what was happening. I could see the space. Trump hated it, which is why I loved it. And you can see where it was going to go. But now he doubled down. It's just a lesson in life. You don't double down after 10x. And that's just called, you're tempting the market gods. So the key thing is, I think we're way overdue for a little bit of shakeup. And that'll be somewhat significant. It's the key thing I like to say. Mean reversion can be very profound. Like 1987 crash was just a simple mean reversion event. The stock market ended up 2% in a year. It's not remembered that way. 1929 was a mean reversion event. 1989 in Japan was a mean reversion event. There's the last two big corrections. There's been 50% drawdowns in U.S. stock market since 2000. When I point out that's probably going to happen again, people look at me with like I have three heads. That's why I think it's important for me. The one thing that I need to do in my space sometimes is when I feel strongly about something is to, as Frederick Douglass says, agitate. And I will do that on purpose because I'm only trying to help people think through versus the sell side's telling them to do. Think about what you're doing if you're overweighting risk assets like cryptocurrencies at these levels. The time to do that was when people hated them in 2010 when it was at or 20, I'm sorry, one's about 10 grand. Now it's the opposite. You're supposed to be looking to, the key thing is, I want to get to, that's what I point out is gold is telling me that. You have to, I look at markets, sometimes they tell you things and it's just my interpretation. And so I started noticing these trajectories that I found very disconcerting. Like, yeah, bullish cryptos, bullish the stock market for a while, and bullish different things. But they were underperforming on risk-adjusted basis of gold. This has been for a while. Now it's just starting to get extreme. And it really scares me. And that's one thing, maybe gold's going to be wrong. It's going to come back. But the key thing I want to point out, so then what I'll do is I'll tilt over to, we'll talk about gold mostly, is the key things is, so you look for signs of an overbought extreme market. And the first thing you go is to futures. Now that's my background. Leverage futures. I love when people say never use leverage. Like, when you grow up using leverage and you know that the lessons are stopping yourself out, and you see the D's, death and divorce, when people get stopped out at bad levels, it's just kind of in the nature. So the key thing I want to point out about gold is futures markets are telling me it's not overbought. I mean, managed money net positions, which are hedge funds, their total open interest on the COMEX about 33%. Historically, to get that market really overbought, you got to get to 47%. So they're well below that. And you see what's happening in ETFs. What's really rare is typically you don't see inflows into gold ETFs when the stock market's on a tear. You usually see them when there's kind of shaky stock market. What's happened this year, John, for the first time in 4 years, we've had significant inflows into gold ETFs. So that's a potential paradigm shift in people saying, yeah, I'm going to start booking profits and taking some of that rock. But I'll end with, I think, what's most important. So if you look at the patterns of the gold market versus the flows in ETFs since 2008, gold market, the ETFs usually led the gold market. Now they're lagging. So something's moving that market. I think it's all the central bank buying. We know it is, but we don't know exactly what they're buying or how much they're buying. So I just look at it as when the deepest pockets on the planet shift to buy something, which is what I've been saying since 2022, you join that trade. And I stick with it. And that's where I'm so worried about cryptos. What shifted in cryptos is now you have to, in the past, I loved them because the administration hated them. Now the administration loves it. You have to be careful, because when's the last time you've seen a sitting president not have a period where they were way down in the polls and some negativity? Like I'm in London right now, and Keir Starmer's just getting hammered in the polls. I mean, the cycles always work. Certainly in the U.S. I'm just remembering when Reagan got hammered for a while, and they all do. And so we're overdue for a little bit of normalization. I think people are overdue for a little bit of unfortunate realization that numbers just don't go up. And that's what you have to call pain.
I think that the thesis on gold makes a lot of sense. Just for our audience to, I want you to kind of bat this around a little bit too, right? The capital that I think is seeking the safe haven in gold is going there. Primarily, my interpretation of what we've seen is that it's seeking stability and safety somewhere outside of the bond market, not necessarily outside of the equity market. So the capital that's in the equities market is still risk on. It still thinks there's going to be strong performance in those markets, but because all of the long bonds for all the Western nations are going up, it's capital leaving there. And like you said, central banks now, for the first time in over 30 years, are holding more gold in reserves than dollar debt. And so it seems to me like that's where that capital is coming from. But that to me isn't reflective of necessarily a need for a correction in risk assets or a weakness in the demand for risk assets, but rather people looking for another safe haven outside of the bond market. Does that align with your view? Am I missing something there? What do you think about that as an explainer for gold?
You can talk about retail speculators or real money. I mean, real deep pension funds, endowments, sovereign nations, and money. And bond yields are going down this year. I would look at that. I mean, maybe up a little bit in China from last year, but 1.77 in China. Japan, 1.58, 10-year note. France, 3.44. Canada, 3.12. There's three handles everywhere. Let's look at Germany, 2.67. US, 4.07. US is the...
Are these 10 or 30 years? Or what,
these are all 10 years. I'm saying all 10-year yields. So yields have
what
been...
are the 30 years? That's what I'm talking about. You see what I'm saying? Like the long bonds is where I feel like the...
So let's look at China, 2.15. Greece, 4.2. US 4.65. We're still the deepest bond market in the world. So the key thing that I've learned in bond markets is every single time I hear that, oh, yields have to go up because we have too much supply, too much debt. I have heard it for decades, John, and every single time I hear that, it's been the wrong trade to do that. So let's look at the facts. Highest debt to GDP on the planet by some measures, Goldman Sachs, China, is 300%, and their 10-year, their bond yield is 30-year, 2.15%. Okay, so it's a closed market, but it's one of the biggest markets in the world. Let's look at Japan, 3.2%. Their debt to GDP is 200%. I traded those things 30 years ago, and I remember that bull market in prices and bear market in yields. It's just the things you need to remember. But the number one thing that's keeping yields in the U.S. up, bond yields, is that U.S. stock market. That's my point, is if we just get that normal correction of 20% or so and stays down, normal stuff, and we're still well over the historical average, the GDP and versus the rest of the world, I think bond yields right now at 4.66 will go to 2. And that's a big trade. And to me, that's what I'm seeing from gold. But it's also, you look at the relative value. Historically, the U.S. Treasury bond prices, I found one metric on the terminal. I have to go back to 1983, divide by gold. That's the last time they were at the same beat up level. And you have to go back 100 years. I overlay that with, you might have seen that posted on Twitter, how expensive the U.S. stock market. That's why I look at it as looking for inflection points in these crocodile jaw patterns. So the value, I think, is... The value at the beginning of the year was gold. Gold's getting expensive. I mean, it's had a great year, up 40% in the year. It's just, you don't want to overweight long gold. Now, I'm concerned when people are, because you really need the stock market to go down, I think. Now, before it was just, it was just a good bull market going. And that's why I'm looking for the next big trade. If you're overweight long cryptos and risk assets, then you probably should look at some kind of protection or hedge. And some of the simplest thing to do is when you make a lot of money, just take some profits. And it looks like some of those profits are going into gold.
I think they might be going into Bitcoin too. But
I don't disagree with that, but I think that's part of it. The key thing people remember is treasuries are safest assets on the planet. Yes, you have duration with long bonds, still are. And we've just gone past that, getting past that cycle of that Larry, I think, is just a little bit late on, of severe inflation. And we're going to tilt towards that severe inflation. We're going to tilt towards that deflation. It's always happened. But the key thing is cryptos as a market, as an index. And Bloomberg Galaxy Crypto Index is a very much high volatility, high beta risk on investment. If you're putting that position on, you probably get 2 to 3 times the volatility of beta of the stock market, and you should expect 2 to 3 times the return on the way up and on the way down. We've had it on the way up, and that's my point. In the last few years, they've been showing significant lagging performance. The Bloomberg Galaxy Crypto Index, Bitcoin, all versus gold. And that's what I point out, as I find out, okay, when you see that and you see the whole world tilting towards, yes, I need to buy Bitcoin because I have to protect against inflation that came in the past, then I start tilting over. That what astute investors do, they look for something that might be tilting the other way.
Gotcha. Okay. I want to get your thoughts on something here. You've said, repeatedly that the U.S. equities market is overvalued. I would say that it appears to me like a few of the U.S. equities are very overvalued. It seems like there's like the top 10, the top 10 stocks are radically overvalued, and then the S&P 490, the rest of them, not really so much. But the thing that's interesting to me about this is that if you look at a lot of the earnings that have been posted by some of these huge outperformers, like Oracle, for example, posted incredible earnings. Their stock jumped up a huge amount. A lot of other like Mag 7 hyperscalers have beat earnings estimates a lot. So it seems like the overvaluation in these equities is also being matched by really outperformance on earnings that in some sense some people have argued might be justifying those valuations. Under that paradigm, do you think that there's any likelihood that maybe the historical overvaluations of the equities might continue even further because the earnings are there to back it up? So you're saying that even though you're expecting there might be a correction, there's also a thesis that maybe this is just going to continue for a long time.
I'm expecting an elongated bear market worthy of the bull market. Okay, now you can call that a crash, a correction, an elongated bear market. I mean, we got one from 2000 to 2007. Because stocks are much more expensive now, and that's just a normal thing to look for. And I look for triggers and I look for alternatives, and that's why my point beginning of the year was overweight gold and treasuries. Now that position has had half the volatility of the stock market and double the return. Because the gold's up 20, gold, half that position is 20%. The rest are treasuries, and maybe that's 2 to 3%. So you're up maybe 25% on the year in a position that is half the volatility of the stock market and a third of the crypto index. That's not a good thing, John. When people who are doing risk off are beating the risk on assets. So think of what happens when we get some normalization. So that's my point. Is the risk is maybe McGlone will look like an idiot and gold will collapse and drop 10%. Okay, maybe that could happen. I mean,
I don't think that'll happen at all. I'm saying that I think they're both going to keep growing. Is what I see. This is what I think is like, because of the debasement, because of the sovereign debt, like the shaken investor confidence in sovereign debt. I think gold is going to continue to grow. I think the Mag 7 are going to continue to grow, and I think that other risk assets like Bitcoin and digital assets will continue to have some gas here too. Now, I do think we will see a bear market in those things, and I do think Bitcoin will correct. I don't agree with you that it'll go back to $10,000 because I don't think there's enough Bitcoin left in the market to sell to get it to $10,000, but that's a separate point. It seems like that there's a potential outcome here where gold continues to perform well as it has this year, and the Mag 7 continue to perform well as well. And I think that that's something I'd like to get your thoughts on, because it seems to me, like I said, the thesis for this has been the shaken investor confidence in the long bonds and the bond market has caused them to look for a safe haven asset in gold. But there's also been a lot of strong GDP, strong earnings reports from the Mag 7 that is continuing to support that bull run as well. Do you think that there's a possibility where this this paired performance between gold and the Mag 7 continues to show strength, both of them at the same time? Or do you think at some point one of them is going to give way to the other?
It's unsustainable. So let's look at that U.S. Treasury 20-plus year bond index. It's up 6.2% total return this year. So I don't know why people are saying bonds are so horrible. You're still up 6.2%. And by the way, your volatility is very low. Yeah, people say 6.2%, but you leverage. That's the thing people forget about bonds. It's the most leveraged market on the planet. That's all I ever did when I was trading treasuries and hedging my futures and bases and stuff. It was highly leveraged. And 6.2% for some people means 50%. Yeah, they had some. That's volatile. So let's not forget that is potentially the tilting over towards that disinflation environment. But I do think it's unsustainable, this wealth creation. And now the Fed cutting rates is great. It's wonderful that they're cutting rates. But I think it's just going to just pop. At some point, the bubble just gets too expensive and it goes down in its own weight. And that's what I'm worried what gold's telling us. So,
okay.
The key fact is earnings have been great, admittedly, and it's a concentrated risk in the stock market, sure. But I still, that S&P 500, the dividend yield in S&P 500 is the lowest since 2001. Earnings yield is the lowest about the same period. It's typically, if you take that S&P 500 total return, it's unchanged since 1997 versus gold. That's not a good sign for these kind of things. And I think that's the point. Here's the point. I think we're getting towards the end game of this massive risk asset rally. And it's like, I'm just hoping the next 3 months will prove that a little more accurate, and we'll see if it's not.
Okay, I want to ask one more question about commodities here. We're coming up on time, so I want to get a couple quick more questions in here. You've been very focused on copper as a commodity. Yeah. You've compared copper to Atlas holding up the world, and you said that if it falls, it's going to take everything down with it. Explain to our audience why you think this is the case. Why is copper such an important commodity to pay attention to right now?
Well, it's the nickname is Dr. Copper, the metal with a PhD in economics. It's a very good leading indicator for global economy, and sometimes it's lagging. And the world economy is facing a shock, a paradigm shift that I've never seen in my lifetime, and most of it hasn't. And this is a 50-year world order, post-World War II order, shifting, where the whole world was able to depend on the U.S. for defense and to just massively have trade surpluses with. Poof, shut that off. Mr. Trump shut that off. So China's in a pretty significant normal deflationary cycle after the inflation. Emerging market that grew too fast. We saw that happen to China. They made another big mistake, though. They pissed off the U.S. and their best customers by this being a decisive enabler of this war in Ukraine, according to NATO. Okay, good luck with that one. But it's just a normal cycle. So here's the facts. What's happening in that deflationary cycle there is they're running 300% debt to GDP. The money supply is running $45 trillion. That's double the U.S. Some measures say 3 times. If you chat GBT, and I didn't get numbers right, my data internal says 2 times. And despite that, the latest PPI number in China is minus 3% about that. And the 10-year notes you'll learn 1.77%. That's severe deflationary forces in the world's second largest economy. It's trickling down. So the rest of the world's facing that. Copper is in the middle. And the thing is, so here's the thing I'm worried about copper. It looks to me just like crude oil did this time of year in 2008. I nailed that trade. First, I got stopped out in that trade. Was wrong. And then when it started to go down, double down and made some really good money, made it all back. And that's part of being a trader. It's a commodity trader. You stop yourself out, you limit your losses, you jump back on, and you just start to make it. So to me, copper is going to tilt down with the rest of the world. And it's like Atlas Shrugged. It has to go up. So to me, it has to go up. If it doesn't, everything tilts down with it because it shows you that tilt. So I'll end with the key facts of copper. It's been trading, the U.S. traded copper, the highest closing price ever on an end of year basis was 446. That was 2010 and 2021. See, that's what commodities do. They go down because they went up. They usually don't stay up over time. The only one that really stays up is gold. If it closes where it is right now, as we speak, it's at 461. That's a great sign for the global economy, despite the fact it's facing a major pushback from the world's largest goods demand importer on the planet? Unlikely. Sure, there's sometimes supply constraints. I don't think it's a big deal. But to me, I think the key thing I want to point out, copper to me is very much like Bitcoin. All the technicals are up. Everybody's bullish. Everybody has the same position on. Everybody agrees you have to buy dips. So what's the optionality? I'm an option trader. Well, it's all priced in. It's going to go up. What's the optionality? It goes down. To me, that's the risk. We've got 3 months to prove me wrong. And I just remember this in 2008. I made a lot of good money watching that crude oil make a new high at 147. It's the highest it's never got back there. This is what copper looks like. It made a high this year around 6 for good reasons. Why? I had a rope in Trump and tariffs because it was the potential for tariffs on U.S. copper. That put up that high around 6. And now we're back down now 4. We have the end of the year. If it starts ticking down to just below the all-time high on an end-of-year basis, you see that tilt I see into the end of the year? That kicks in the algos that kick in nothing but sells. Nothing but sells. Give me a rally to sell and everything. Bitcoin and copper and bond yields. That's what I'm worried about, Sean. I'm worried about a situation that happened like in 1929, where it all kicked in starting September, October, and I'm afraid it's going to start in cryptos. And that's why I'm looking for those signs. Hope I'm wrong. I think all our readers hope I'm wrong, but gold's telling me I'm going to be right.
Mike, I want to say again, I really appreciate your coming on the show today, sharing your thoughts and insight. I always learn something from talking to you. You're, like I said, an agitator, a bear, a self-described agitator, no less. But you do so in a really great way because that's a great way to share ideas and learn things. So I really appreciate that. To just kind of bring this together for the audience a little bit. So we've seen a 25 basis point cut from the Fed. There's projections for 2 more before the end of the year. However, as Jerome Powell has gone to great lengths to say, this is a quote risk management cut, not a full pivot to 0% interest rates and unleash the bulls. The economic indicators of the market in terms of hiring still look kind of weak. And you're looking at copper as a leading indicator of economic activity and how that might give us a signal that we get a correction in the equities markets and indeed the broader markets. Just as a last thing to give the audience on the way out the door, what one thing besides copper, or maybe it is copper, but what are you looking for to pay attention to in Q4 as we go forward, get more rate cuts? What are you watching for here?
Bitcoin. And so here's, I knew that would get you to smile. I hope our audience appreciates it. I'm not trying to antagonize.
At some point, I gotta have like a half an hour just to talk about Bitcoin with you because I think it would be so much fun.
I just love when young people try to educate me about you don't understand this. Like Larry told me once, I didn't understand. Like Larry, I made a good 10x in Bitcoin just by figuring it out early. Not early, but my son figured it out real early. I mean, in 2011, he forgot what he lost his computer mind. But so the key thing I want to point out is
because educated, we just see it different.
No, my point is here's the key thing is you learn as a strategist. When you say something that you feels a little bit against consensus and people respond to you with some angry chagrin, then what their position is, and you touched something. And when the problem is when everybody agrees with you, you're usually wrong. So that's the point. I've had most of my knowledge and career in cryptos is I was extraordinarily bullish. Yeah, I got bearish too early because it hasn't gone down yet, but this has happened to me in the past. My point is this space, I think people are underestimating how it could be very much like what collapsed the stock market in 1987, which was like portfolio insurance, what collapsed at 1929, which was all these leveraged mutual fund positions. What collapsed it in 2001 was just massive speculation and hubris in internet stocks. It's all that together on steroids. And I just love the fact that there's 21 million and some people who are involved think, oh, you're an idiot. And I'm like, yes. They don't understand when you come from a family of 6, you work at a trading pit so much. That's just love. I love it. I'll hug you too. But you look at things like Bitcoin. It was like Dogecoin, $40 trillion. It tracks nothing, launched as a joke. It's going to go down to 4,000 at some point, dollars. It's just a question of when. And maybe McGlone will be wrong a year from now, but it's just a question of time when normalization to kick in, people realize I need money, and the whole thing goes poof. And I'm waiting for that. I'm afraid of it, and then I'm really scared of what it might do. To me, I'll end with this. I wrote a comment a little while ago. The next recession might be led by Bitcoin and cryptos because it's when you take money away from people, we take wealth away. It's usually much worse than when you create it. But well, I do enjoy bantering with you, John. It's fun.
You too, sir. Yeah, and look, I could return fire, but I'm going to give you the last word because you're the guest. Like I said,
you should. You should. It's your show.
Well, it's my show, but you're my guest.
Yeah.
All right. Well, I'll say a couple of things.
Yeah. Please.
Maybe I'll just say one thing. I worked at BlackRock for 6 years. I'm by no means anywhere near your level of experience, but I did work closely with the digital assets team. We worked on a couple of papers while I was there. One was called Bitcoin, a Unique Diversifier, about how to, all these things. I think there's a thesis there that's starting to gain some traction, which I would also point you to. I don't think that the original white paper of like replacing currency is the current use in the market that Bitcoin is playing for, right? I think the dollar is currency. Bitcoin is playing for capital. It's competing more with gold. That's just where it is right now. That could evolve. That could change. But in the Bitcoin cash wars, that was kind of decided by the community because Bitcoin is also something that involves people, and people are part of the network as well. How people choose to use an open protocol determines in some sense what that protocol and what that asset is, and that's how the community is choosing to use it. And the last thing I'll say is Robbie Mitchnick, the head of digital assets at BlackRock, had a very simple phrase that he liked to use, which he said, Bitcoin is massively short real interest rates. and the Federal Reserve is cutting interest rates. And so we'll see how that all goes. But in any event, this has been really fun. I really appreciate your thoughts on this. I think I learned a lot. I'm sure our audience did too. I'm gonna have to watch this again on slow it down and figure out what you actually said, because you just spew alpha so fast I can't keep up sometimes. But thanks for being here, Mike. I hope we can have you back again on Milk Road Macro. Thanks for doing this. I really appreciate it.
John, it was fun. Thanks for having me. You caught me at a nice evening in London, and I'm looking forward to our next conversation, that we can maybe a few months from now look back at this and say how it worked out. It's going to be interesting.
Absolutely. Looking forward to it, sir. Take care in the meantime, all right?
Thanks for having me.
All right. Thank you all for joining us. Stay safe, stay bullish, stay educated, and we will see you all next time on Milk Road Macro. Thanks for being here. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.